The financialization of housing refers to the processes that lead to housing becoming an asset class, expanding its role to a financial asset rather than solely a consumption good. Historically, housing finance was very localized, insulated from international capital flows. Your neighborhood bank handled your mortgage, and if they ran out of money to lend for mortgages, tough luck. Integrating the mortgage market into the global financial system over the last couple of decades has effectively removed this constraint, extending easier access to credit and ultimately home ownership to everyone. The Federal Housing Administration, FHA, predates and was involved in this trend. It insures the mortgages of certain property, making it safer for banks to lend by stepping in for defaulting borrowers and appraising and imposing quality standards on the collateral, meaning the house. After World War II, the Department of Veteran Affairs also insured mortgages to enable home ownership. So now we have enormous financial flows necessitated by the growth in mortgages leading up to the 1970s. The problem for the loaning bank is that a mortgage is a very long-run, illiquid financial instrument. It just sits on its shelf. The bank would rather have liquid cash to make new loans and mortgages. That means it would like to sell the mortgage to someone for money. It is not hard to calculate how much the mortgage is worth presently. The market that these mortgage for money trades create is called the secondary mortgage market, since you're just trading in existing things like a second-hand store. This is done mostly by absolutely enormous government agencies you might have heard of. The Government National Mortgage Association, GNMA or Ginnie, the Federal National Mortgage Association, FNMA or Fannie Mae, and the Federal Home Loan Mortgage Corporation, FHLMC, or not quite as obviously, Freddie Mac. Fannie Mae and Freddie Mac are so-called government-sponsored enterprises, or GSEs, that actively buy mortgages from lenders, providing liquidity to banks, pool these mortgages, and then issue mortgage-backed securities, or MBSs, meaning the MBSs are backed by those mortgages Fannie and Freddie bought. They guarantee payment of principal and interest on the underlying mortgages to the buyers of the MBSs. Even when the borrower defaults, the people buying the MBS will keep receiving payments as though the default didn't happen. So Fannie and Freddie hold mortgage assets on their balance sheets and essentially sell the right to the payment streams of those mortgages. That's what you buy when you buy an MBS. Fannie and Freddie finance buying those mortgages by issuing their own debt, meaning they raise funds by borrowing from investors, then use that money to buy mortgages from lenders. Because they are perceived as essentially risk-free, even though they are not technically backed by the government, Fannie and Freddie can borrow at comically low rates. Where do they make their money? Not from the underlying mortgages, since those payments go through to the buyers of the MBS. Their revenue mainly comes from guarantee fees. These are small ongoing fees charged for guaranteeing timely payment of principal and interest to the MBS investors, not dissimilar to how you pay your insurance's monthly fees to take on some of your risks. Fannie and Freddie's mission is to buy mortgages that meet their standards irrespective of market conditions, to be reliable sources of liquidity to the mortgage markets. Ginnie Mae, on the other hand, does not buy or own mortgages. Instead, it guarantees MBSs issued by approved private lenders that are backed by government-insured or guaranteed loans, mostly loans insured by the FHA, the Department of Veteran Affairs, or the USDA. Ginnie Mae's guarantee is a so-called full faith and credit pledge backed by the US Treasury to ensure investors receive timely payments, which effectively eliminates credit risk for investors, since the US Treasury will never default. Ginnie Mae makes its money by charging issuers, meaning the approved lenders who create Ginnie Mae MBSs, a fee, typically a small percentage of the outstanding principal on the securities it guarantees. These issuer fees cover Ginnie Mae's operating costs and provide a modest revenue stream. Ginnie Mae itself does not hold credit risk or issue securities. It is a guarantor only, like an insurance. It does not hold credit risk in the sense that its balance sheet is unaffected by the performance of the mortgages it guarantees, since it does not actually buy them. In contrast, Fannie and Freddie actually buy mortgages from lenders, bundle them into MBSs, and then issue those securities themselves with their own guarantees. You can become a GNMA-approved MBS guy, but not a Fannie and Freddie-approved MBS guy, since they make their own MBSs. If the underlying mortgages default, Fannie and Freddie's balance sheets deteriorate. As mentioned, Ginnie Mae guarantees are limited to loans insured or guaranteed by federal agencies like the FHA, VA, or USDA, which have strict underwriting standards. Underwriting is just the process lenders use to evaluate the risk of making a loan to a borrower, so verifying the borrower's income, credit history, employment, debt, and the value of property being purchased. These Ginnie Mae guaranteed MBSs do not include subprime mortgage loans, which literally just means loans with weaker credit quality. Fannie Mae and Freddie Mac, however, did purchase and turn into securities some subprime mortgages, especially in the years leading up to the 2008 financial crisis. Underwriting practices were lacking, things that should have been checked weren't, and the data to accurately calibrate the default risk of these subprime mortgages were insufficient. Since then, though, both agencies have significantly tightened their underwriting criteria and exited most subprime lending. And this was a political decision the same way lower underwriting standards and entering the subprime market in the first place were strongly influenced by the political process as well. To reiterate, this entire edifice is to take the illiquid mortgages off of banks' hands and give them liquid money so that they can make mortgages again, since it is a policy goal of the US government to increase home ownership. Elected officials didn't just want to expand home ownership generally. They also wanted to expand credit for buying homes to minorities specifically, combating practices like redlining, where banks would avoid giving loans to people in certain majority black neighborhoods. The Fair Housing Act of 1968, part of the Civil Rights Act passed that year, prohibited discrimination in the sale, rental, and financing of housing based on race, religion, national origin, and later other protected characteristics. Enforcement was weak and discrimination persisted. To shine more light on lending patterns, Congress passed the Home Mortgage Disclosure Act, HMDA, or HMDA, in 1975, requiring lenders to make public certain data like geographic distribution of loans, so that regulators and the public could spot potential discrimination. 2 years later came the Community Reinvestment Act, or CRA, of 1977, which was more forceful. It obliged banks to meet the credit needs of the communities in which they operated, including low and moderate income neighborhoods. And it made bank expansion or mergers contingent on compliance with the CRA. In 1992, the Housing and Community Development Act extended this push into the government-sponsored enterprises themselves. It set specific affordable housing goals for Fannie Mae and Freddie Mac, directing them to devote a certain share of their lending to low-income borrowers and historically underserved areas. This formalized their role not just as liquidity providers for the mortgage market overall, but as expanding home ownership among minorities and the poor in particular. You can certainly debate whether all or any of this was a good idea from different angles. Why are we trying to increase homeownership in the first place? Why were banks not lending as much to low-income households? Maybe they had good reasons. But I do want to deal with one talking point in particular. The increased lending to low-income individuals and minorities enabled by the developments I just outlined is largely overstated as a major direct cause of the 2008 financial crisis. The affordable housing goals of Fannie and Freddie and the CRA had little measurable impact on the home ownership rate or on the overall quality of prime and subprime loans from the mid-90s all the way to 2007. Only about 1 in 20 subprime mortgages in the run-up to the crisis even qualified under the CRA, and these performed no worse than non-CRA subprime loans. Given that performance was similar, the idea that the CRA pushed banks into making large volumes of risky loans seems unlikely. The CRA had been in place for decades before the crisis, and Fannie and Freddie's affordable housing mandates began in the early 90s, well before the subprime boom. While they both did buy significant amounts of subprime MBSs, much of this activity was unrelated to CRA goals, since it didn't qualify. Moreover, their purchases of newly issued subprime securities declined in the last couple of years before the market's most explosive growth in 2005 and 6, making it difficult to argue they were the primary drivers of that late-stage surge. Private label MBSs represented just over a majority in the secondary market, larger than what Fannie and Freddie were providing. The core problem was the underpricing of credit given out to home buyers vis-à-vis their risk of default, which in turn was caused by 3 central factors. Each factor contributed to obscuring the risks involved. Agency problems in the mortgage market leading to lax underwriting and bad data, financial innovation creating products that were inherently complicated to price and did not have a lot of historical data to be priced anyway, and finally, moral hazard on the end of the independent credit rating agencies. Many mortgage brokers and other lenders followed an originate-to-distribute model where newly originated mortgages were immediately bundled and sold again as MBSs. Their involvement with the mortgage would end right there, so they had no strong incentives to make sure the borrower had a low default risk, meaning they could actually pay the mortgage, which would have been in the interest of the investor buying the MBS, but also the borrower, who's usually not very well able to estimate whether a loan makes sense for them. This was exacerbated by loosely enforced disclosure requirements from the mortgage brokers that, in a sense, did not have to give good advice to their customers. And often they may not have been able to because they themselves were not well informed. And why would they be if there was no legal requirement? Accordingly, many subprime loans defaulted soon after origination, indicating borrowers were in fact unable to make payments from the start. since the banks buying the mortgages and the other financial institutions buying the MBSs and packaging them into more complicated products immediately sold them as well, they faced similar incentive problems. Financial innovation created structured credit products, notoriously, for example, the collateralized debt obligation, or CDO. These package, for example, multiple mortgage-backed securities together and then sell their payment streams in tranches of different priority. High-priority tranches get paid first, meaning even if most underlying MBSs evaporate, they still get paid from the remainder. Low-priority tranches get paid last, meaning their risk is higher and accordingly their returns are higher. The benefit of this is that investors with different risk preferences can easily buy into the MBS market. The problem is that the risk structure of these investments is difficult to evaluate. We are not evaluating individual borrowers taking out mortgages, we are not even evaluating a package of multiple of them, which is what an MBS is, but we are thinking about a slice of a bundle of collections of mortgages. Even more complicated than are CDO squareds and higher powers like CDO cubeds that package multiple CDOs in a similar fashion. Thirdly, there were the credit rating agencies. Rating agencies' job is to evaluate the default risk of debt instruments like CDOs. Usually they do this just fine and fulfill an important function. Leading up to the crisis though, they also advised their clients on how to structure some of these instruments they themselves were rating, introducing moral hazard. They had bad incentives to get it right. Agencies were advising banks on how to structure securities to achieve the highest possible ratings, while simultaneously being paid by those same banks to rate them. Additionally, credit rating agencies operated in a protected oligopoly, just Moody's, S&P, and Fitch, whose ratings were embedded in financial regulations. Many institutional investors were legally required to use their ratings, and the complexity of structured products made independent evaluation difficult. All of this meant the default risk of the mortgage market was estimated too low, and credit was given out too cheap and to too many people. As long as housing prices were rising though, that did not matter. Default was unlikely, since a borrower unable to pay could just sell their house and pay off the loan completely, ensuring everyone down the line, through mortgage originator, MBS buyer, and CDO investor, would get paid. Problems arrived when housing prices stopped rising and the value of houses fell below the value of their mortgages. The trigger ultimately was rising foreclosures, as for example interest rates started to reset on many of the adjustable rate mortgages, or ARMs, and payments jumped up. Not to imply that ARMs were the sole trigger. In normal conditions, ARMs can be a good option for borrowers who want lower initial payments and are comfortable taking on interest rate risk themselves. Since the lender no longer needs to protect against long-term rate changes, the initial rate is typically lower than for a fixed-rate mortgage. However, this shifts the risk of rate increases onto the borrower. This can become costly if rates rise and the borrower cannot refinance or sell. Because many of those ARMs were made to highly leveraged borrowers with little equity and weak underwriting, any payment shock or a drop in home prices pushed them into default. As in, they couldn't refinance their mortgage because their debt was higher than the house plus other equity was worth. With tighter underwriting, these people simply wouldn't have gotten the mortgage and wouldn't have been homeowners. When you default on your mortgage, the bank gets the house. But as mentioned, the problem was that the house was worth less than the debt owed, so the balance sheets of the financial institutions involved in the housing market, be that in mortgages or the securities based on them, began to deteriorate as more and more defaults rolled in. This was the start of the financial crisis. The key is the deterioration of the balance sheets of the financial institutions. What happened next is more financial economics than housing policy, and I'd refer you to the Mishkin textbook in the sources for details. But the basic mechanism is that lending institutions deleveraged, that is, shrink their balance sheets by selling assets. Loans are assets to banks, even though they aren't to you. Cutting lending and raising capital to reduce debt relative to equity, improving their balance sheet composition again. This reduction in lending exacerbates information problems and leads to misallocation of capital. A financial crisis is when banks and other financial institutions stop doing what banks normally do: evaluate borrowers and make loans to them. This evaluation alleviates information problems inherent in capital markets. The mother of all financial crises would thus be if we abolished the financial industry entirely. Simply letting the banks fail is not an option for that reason. Populist sentiment to punish the banks was probably behind calls in that direction, but you can't let banks fail and fight the financial crisis at the same time, any more than you can make every child into an above-average student simultaneously. Actual individual bankers, of course, did feel consequences. They lost their jobs and millions in income. Complaints that practically no one was criminally charged seem silly to me. What would you charge them with? Making loans and buying financial instruments? There is a more sophisticated point here about the moral hazard and adverse selection of the government bailouts of the banks. But that's clearly not what animated protesters hand-wringing about bankers' bonuses, as though these were in any way substantively relevant rather than just bad optics. So a central policy issue was actually under-regulation, in stark contrast to the current problems of undersupply in the housing market, which are problems of non-financial over-regulation. Deregulation removed interest rate ceilings and allowed adjustable rate mortgages, which was generally a good thing, and insufficient regulation of subprime and exotic mortgages in the 90s and 2000s further facilitated their expansion. Underwriting was insufficiently enforced, and new products emerged faster than regulators could adapt their risk management standards. This is a general problem of financial innovation, not just of the housing crisis. What happened to Fannie and Freddie, whom I started with? The government took control of them, where they remain today, with ongoing restructuring to prevent similar crises in the future. Some policy measures, either planned or actually undertaken, that make sense leap off the page. Stricter mortgage underwriting standards requiring full documentation of income, assets and employment, and restricting high loan-to-value and high debt-to-income ratios. This will prevent people with high default risk to get mortgages and buy homes. Supervision of rating agencies, liability for poor ratings, and rules to reduce conflicts of interest. And higher capital requirements for banks holding mortgage-related assets. Also stricter treatment of mortgage-backed securities in bank balance sheets. This is reflected in Basel III. A famous package of new regulation was the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, which was the quasi-official response of the Obama administration to the crisis. It created the Consumer Financial Protection Bureau, CFPB, to regulate mortgages and protect borrowers from predatory lending. If you recall, one problem was that mortgage originators did not properly inform borrowers. The Act is also responsible for the mentioned supervision of rating agencies by the SEC. Dodd-Frank introduced ability to repay, or ATR, meaning lenders must verify borrowers' capacity to repay. And it introduced rules for what counts as a qualified mortgage, which is about limits on risky loan features like runtimes longer than 30 years or negative amortization. Again, recall the agency problems that existed in the mortgage market of originators not caring about the default risk of their customers because they would quickly sell the mortgage anyway. The Act also introduced some risk retention. Securitizers of mortgages must usually keep at least 5% of the credit risk, aligning incentives to make sure the people bundling a bunch of mortgages together care about the underlying quality. Obviously, there is more to say about the Act, and I've highlighted the positive aspects that responded to specific problems that caused the crisis. The bill was heavily lobbied by the industry, in part probably for a good reason, and opposed by Republicans, probably for no good reason at all. While Fannie and Freddie were merely placed into federal conservatorship, there were more radical proposals for explicit government backing of Fannie and Freddie, like with Ginnie. These proposals imagined a new federal entity, such as a Federal Mortgage Insurance Corporation, which would replace Fannie Mae and Freddie Mac. This entity would make government-backed guarantees for catastrophic losses on mortgage-backed securities, essentially extending what Ginnie Mae does to more forms of MBSs that aren't covered by her. The government's role would be to act as a reinsurer for tail risks, losses that exceed private capital's capacity, charging a guarantee fee like Ginnie does for this reinsurance. A core feature would have been the requirement for private investors to bear the so-called first loss on mortgage pools before the government guarantee kicks in. For example, a 10% first loss private capital requirement for guaranteed MBSs. This private capital was intended to incentivize prudence in underwriting and risk management among private firms. Countercyclical capital requirements may have been included as well, allowing the first loss capital to be reduced during periods of significant financial stress to maintain credit supply, and increased during boom times to curb excessive risk-taking. More and countercyclical capital requirements were proposed not just for mortgage-based securities, but more broadly. Some policymakers and industry groups also proposed creating a national mortgage note registry. The idea was to establish a centralized database recording ownership and servicing rights for every mortgage in the country, replacing the patchwork of county-level title systems and the opaque, privately run Mortgage Electronic Registration System, or MERS. Proponents argued it would improve transparency, reduce legal uncertainty over who owns a loan, speed up transfers, and prevent the documentation gaps that hampered foreclosures and securitization during the crisis and its management. Nothing like a full national mortgage note registry was ever implemented. Instead, reforms focused on improving MERS practices and strengthening state-level recording and disclosure requirements. That housing involves financial markets is ultimately inevitable given the high costs of buying a house. But the extent of financialization it underwent was not inevitable. Finance can make people kind of loopy. The idea of a CDO cubed, once explained, is so grotesque to some people they want to make it illegal to restore the natural order of the world. They register investment and speculation as a kind of degeneracy. How a Nazi may view a trans person, how a devout Muslim might react to pork being served at their mosque, or how a traditionalist views modern art inside a classical cathedral. A forward contract on grain seems like dangerous gambling to them that will literally cause famine if allowed. Moving money around is prima facie suspect and in need of justification. Financial markets should be restricted and actions within them disallowed until good reasons can be given to allow them. So the opposite of laissez-faire. The populist response to the financial crisis is thus to shut it all down. The West has fallen, billions must default, return to mortgages made by local banks only. For example, some people seem to admire Fight Club's Tyler Durden, not just for being cool and attractive, but for his substantive policy goal, realized at the end of the movie, of wiping out all debt. But the financialization of housing was driven by market forces and therefore represents mutually beneficial agreements. The ideas of mortgage-backed securities and CTOs are clever and make sense to me at least. Having access to global financial markets should give people access to better and cheaper financial products, the same way that having access to regular global markets gives people access to better and cheaper regular products and services. This, of course, does not faze the populist, who's also suspicious of markets in general, thinking each market interaction should in principle be reviewed by committee. A common talking point in this context, especially in online discussions, blames large institutional investors such as BlackRock, Vanguard, or other private equity and asset management firms for surging housing prices. To these people, regulation, decided by committee, is inherently trustworthy, although it is the actual culprit of high prices, while whatever it is markets are doing is probably the root of all evil. The story goes that these firms are buying up huge shares of single-family homes, keeping them off the market, or renting them out at inflated prices, thus shutting ordinary buyers out. To many, this is an intuitively appealing narrative because it puts a visible villain in the frame, one with deep pockets and little sympathy for the public. The data, however, do not support the idea that such investors are a major driver of national housing price trends. Large institutional buyers account for a very small share of the overall housing market. Estimates for single-family homes are typically in the low single-digit percentages of annual transactions, even during peak buying years. Most housing purchases are still made by individual households, small landlords, or local investors. While concentrated purchases by an institutional player can have noticeable effects in certain neighborhoods or distressed markets, such as post-2008 foreclosure hotspots, this is very different from determining nationwide price levels. These are driven primarily by fundamentals like supply constraints, zoning laws, population growth, and low interest rates. Think tanks and housing economists generally conclude that institutional investors are more symptom than cause. They enter markets where conditions already favor price growth and rental demand. That's why they enter. And they scale back when these conditions weaken. That does not mean their presence is irrelevant, but the notion that BlackRock is buying on their houses and single-handedly inflating prices is a political myth, not an evidence-based explanation.